Today, we're diving into an important topic that's making waves in the Canadian mortgage market. The Bank of Canada, through its Senior Deputy Governor Carolyn Rogers, has issued a word of caution regarding potential adjustments to mortgage rules. According to a report from BNN Bloomberg, Rogers highlighted the risks associated with making excessive changes to tackle housing affordability issues. She emphasized that such tweaks could have unforeseen consequences for both households and the broader economy. Speaking at an event in Toronto, Rogers advised against tinkering too much with the mortgage market. She pointed out that the high home prices we're witnessing in Canada are primarily due to a supply and demand imbalance. This imbalance is something that's going to take time to address, she noted. Rogers did express optimism about the government's efforts at various levels to tackle these housing challenges through innovative solutions. However, she stressed the importance of a measured approach. Rogers cautioned policymakers and regulators about the potential long-term impacts of focusing too heavily on measures aimed at reducing short-term financing costs. Leaning too much on measures that reduce the short-term cost of financing could have long-term impacts, she remarked. This is a crucial point, especially in light of recent changes announced by Prime Minister Justin Trudeau's administration, such as extending amortization periods to 30 years from 25 for certain borrowers, and allowing insured mortgages on homes valued up to $1.5 million. Rogers illustrated the potential repercussions of extended amortizations by explaining that while adding 5 years to a mortgage term might lower monthly payments by $200, it could also increase the total interest costs by $50,000 over the mortgage's duration. While these adjustments might enhance returns for lenders, they could also introduce greater risks for both borrowers and lenders. She warned that financially stressed borrowers might use amortization extensions as a temporary relief, but once they reach the maximum duration, that safety net disappears. Moreover, lenders might face higher capital demands, which could ultimately lead to elevated interest rates for households. Rogers also addressed the current perception that Canadian households are struggling with rising borrowing costs as they renew their mortgages at higher rates post-pandemic. Interestingly, she mentioned that despite the economic turbulence and sharp rise in interest rates, the mortgage market has fared well, with arrears rates rising but remaining near historically low levels. In her speech, Rogers commended the return of inflation to the bank's 2% target, attributing this success to the efficacy of the bank's monetary policy. She acknowledged that the recent rate hikes were tough, but ultimately necessary to stabilize prices. It did get inflation under control without creating the sharp economic downturn that many feared, she noted. With interest rates beginning to descend, there's a hopeful prospect of further normalization ahead. Last month, the central bank made a notable move by reducing borrowing costs by 0.5 percentage point, setting the benchmark overnight rate at 3.75%. Rogers also touched on the limited availability of longer-term mortgage options in Canada, suggesting that policy changes may be necessary to diversify the market beyond the typical 5-year term. In a significant development for the Canadian housing market, the government has announced revised mortgage rates for 2024, offering substantial relief to both homeowners and first-time buyers. This move is part of a broader strategy to make homeownership more affordable in high-cost markets like Toronto and Vancouver, where housing prices have soared in recent years. The Bank of Canada has been proactive, lowering its policy rate to 4.25% after 3 consecutive cuts throughout 2024. This reduction marks a 75 basis point decrease from the previous year, allowing mortgage holders with variable rates to benefit from lower borrowing costs. For example, a homeowner with a $667,000 home and a 10% down payment saw their monthly payments decrease by around $70 after the latest 0.25% rate cut in September 2024. In addition to the interest rate cuts, the government has made bold reforms to mortgage policies. One of the most notable changes is the increase in the insured mortgage cap from $1 million to $1.5 million, effective December 15, 2024. This adjustment is particularly impactful in major cities where the average home price often exceeds $1 million, allowing more buyers to qualify for insured mortgages with lower down payments. Furthermore, the government has expanded the availability of 30-year amortizations for insured mortgages, which was previously limited to newly built homes. Starting December 15, 2024, all homebuyers can access these extended terms, reducing monthly payments by approximately 9% compared to the standard 25-year amortization. This change is expected to provide significant relief to buyers struggling with affordability, especially in high-price areas. Another key reform is the ability for borrowers to switch mortgage lenders without requalifying at renewal. Under the new rules, insured mortgage holders can now shop around for better rates without undergoing another stress test. This change is designed to increase competition among lenders and allow homeowners to secure more favorable terms, further easing their financial burden. The implications of these changes are far-reaching. First-time homebuyers in particular will benefit from lower monthly payments and increased access to government-backed insurance. Analysts forecast that the 5-year fixed mortgage rate could drop to 5.4% by the end of 2024, down from its peak of 6.4% in 2023, offering even more attractive options for new entrants to the housing market. For current homeowners, the recent rate cuts have brought much-needed relief, especially for those with variable-rate mortgages. The ability to switch lenders without requalifying also empowers them to negotiate better terms. Real estate investors, particularly those in pre-construction, are likely to see renewed interest thanks to the availability of 30-year amortizations, which offer a cushion against rising costs. The recent rise in bond yields has sparked discussions about its potential impact on fixed mortgage rates. Historically, when bond yields increase, fixed mortgage rates tend to follow suit. However, borrowers can breathe a sigh of relief for now, as the anticipated rise in fixed mortgage rates has been mild. This is largely due to a couple of factors that have kept the upward pressure in check. First, the Federal Reserve's recent decision to cut its key interest rate by 25 basis points has played a significant role. This move, coupled with the Fed's indication of possible future cuts, has led bond traders to lower yields, which in turn has eased the pressure on fixed mortgage rates. In addition to the Fed's influence, lenders have also contributed to the stability of fixed mortgage rates. During a period of declining yields from July to mid-September, lenders built up a margin cushion. Now that yields have started to rise again, many lenders are choosing to absorb some of the increased costs rather than passing them on to consumers through higher rates. As a result, the lowest nationally advertised uninsured fixed rate remains unchanged this week at 4.64% for a 3- or 5-year fixed mortgage. This rate is only up by 10 basis points from its 2-year low, indicating that lenders are indeed cushioning the impact of rising bond yields. On the other hand, variable mortgage rates are on a downward trend. Markets are currently anticipating a 25 to 50 basis point cut by the Bank of Canada on December 11th, with expectations of a total reduction of 100 basis points over the next 12 months. This outlook is influenced by various factors, including potential economic policies from the United States that could either bolster or hinder Canada's economic performance. In Toronto's real estate market, a recent sale has caught the attention of many, highlighting the challenges faced by homeowners in today's economic climate. A property in North York, which was initially purchased for $3.1 million in April 2022, was sold for $2.6 million just last week, resulting in a significant loss of $500,000. This happened after the home sat on the market for only 3 weeks, underscoring a sense of urgency among sellers. The property in question is quite impressive, featuring 4 bedrooms, 5 bathrooms, custom-trimmed windows, a 2-car garage, a finished basement with a walk-up entrance, and a spacious backyard. Despite these appealing features, the property struggled to attract buyers at its original value, reflecting broader market dynamics. This case is not isolated. According to Shazi, a real estate creator who shares updates on Ontario's market, North York has become a focal point for price drops. Known for its family-friendly communities and detached homes, it's surprising to see such a historically strong market facing these challenges. The swift sale at a substantial loss suggests sellers are becoming increasingly desperate to offload properties in a timely manner. The Toronto Regional Real Estate Board, TRREB, recently reported that while home sales in October 2024 were up year over year. The average selling price only saw a slight increase. This indicates that while more buyers are entering the market, possibly spurred by the Bank of Canada's rate cuts, the overall price growth remains moderate due to ample inventory. TARREB President Jennifer Pierce noted that the positive affordability picture, driven by reduced borrowing costs, has encouraged many buyers to re-engage with the market. However, the market is still influenced by high inventory levels, which provide buyers with more choices and keep price growth in check. TARREB Chief Market Analyst Jason Mercer highlighted that as the current inventory is absorbed and home construction continues to lag behind population growth, we can expect a potential acceleration in home price growth, particularly as we move into the spring of 2025. This could change the current dynamics and place upward pressure on prices. The situation in North York might serve as a cautionary tale for other markets across Canada. It's a reminder of how quickly market conditions can shift and the importance of strategic decision-making when buying or selling real estate. While some may see this as a moment of opportunity to enter the market, others might view it as a warning to proceed with caution. Today, we have an intriguing development in the rental market, as national rent prices across Canada have declined on a year-over-year basis for the first time since the pandemic began. According to a report released by Rentals.ca and Urbanation, the average asking rents in Canada sat at $2,150 in October, marking a 1.2% decrease from the same month last year. This is the first national decline observed since July 2021. The report highlights that the decline is primarily concentrated in major urban centers, with cities such as Toronto, Vancouver, Calgary, and Montreal experiencing notable decreases in rent prices. Sean Hildebrand, the president of Urbanation, emphasized the rarity of such a national-level decline. He attributes this trend to the reversal of key factors that have driven rent growth in recent years, including a strong economy, rapid population growth, and deteriorating homeownership affordability. Hildebrand suggests that this downward trend in rents is likely to continue in the near term, especially as apartment completions are at record highs. This is an interesting dynamic, as it indicates a shift in the rental market that could provide some relief to renters who have been facing escalating costs over the past few years. Examining the data by province, British Columbia and Ontario have recorded the most significant annual rent decreases. In British Columbia, the average asking rents for apartments fell by 3.4% to $25.49, while in Ontario there was a 5.7% drop to $2,350. This is a surprising development given the high demand and limited supply often cited in these regions. On the flip side, Saskatchewan has experienced a 17.1% increase in rents, making it the fastest-growing province in terms of asking prices. This follows a 23.5% annual growth in September, indicating a strong rental market in the province despite the national trend. Looking at specific cities, Toronto recorded the largest annual decline in asking rents for apartments at 9.2%, bringing the average rent down to $2,640. Vancouver wasn't far behind, with an 8.4% decline to an average of $2,945. Meanwhile, Calgary saw a 4.7% drop to $1,995, and Montreal's rents decreased by 2.9% to $1,987. Interestingly, Ottawa's rents remained relatively stable, with a slight 0.4% increase to $2,207. However, Edmonton stands out as an exception among Canada's largest markets, with apartment rents rising by 8.4% to an average of $1,584, bucking the overall national trend. This suggests that local economic conditions and supply-demand dynamics can significantly influence rent prices, even when broader trends are at play. The report also provides insights into the average asking rents for different types of units. For a one-bedroom unit in Canada, the average asking rent was $1,923 in October, down 0.8% from a year ago. Two-bedroom units saw a slight decrease of 0.2% with an average asking price of $2,388. Interestingly, purpose-built rental apartments experienced a 1.7% increase in asking rents compared to a year earlier, reaching an average of $2,100. On the other hand, condominium apartment rents decreased by 3.8%, averaging $2,265. These changes in rent prices reflect the evolving dynamics of the Canadian housing market. As we navigate through these fluctuations, it's essential for both renters and landlords to stay informed and adapt to the shifting landscape. Whether you're considering renting or investing in rental properties, understanding these trends can help you make more strategic decisions. As always, keep an eye on these developments as they unfold, as they can have significant implications for the broader real estate market as well. Today, we're exploring an exciting development in the Canadian mortgage market that's gaining traction: Halal mortgage solutions. The Alberta government has recently introduced a new law that could potentially increase the availability of halal mortgages in the province. This type of financing is designed with Muslim Canadians in mind, as it adheres to Sharia law, which prohibits the payment of interest. Under a typical halal mortgage structure, the lender calculates the total interest that would be paid over the life of a conventional mortgage and charges that amount as an upfront fee instead. This approach allows borrowers to avoid interest payments altogether. While a few private lenders in Canada currently offer halal home financing, the country's major banks have yet to introduce such products. However, the new law in Alberta is expected to encourage more lenders to develop halal mortgage offerings. Alberta's finance minister has expressed optimism that these new halal mortgage products will emerge swiftly, given that local lenders have been advocating for this legal change. This could open up new opportunities for Muslim Canadians seeking home ownership solutions that align with their religious beliefs. It's important to note that halal mortgages aren't exclusively for Muslim Canadians. Anyone can take advantage of this model, which might appeal to those looking for a more straightforward payment structure. Although it may not necessarily save money, the appeal lies in avoiding the uncertainties of fluctuating interest rates and opting for a clear upfront payment. On a national scale, the Canadian government has announced plans in the 2024 budget to collaborate with financial institutions to expand halal financing options across the country. This initiative is expected to gain further momentum, with updates anticipated later this fall. Such developments could pave the way for more inclusive financing solutions in the Canadian housing market. Today, we're turning our attention to Montreal, where the housing market has experienced a remarkable surge in sales this past October. According to the Quebec Professional Association of Real Estate Brokers, Montreal's housing market witnessed a significant 44% increase in sales year over year, marking the strongest October sales growth in over 2 decades. This upswing is evident across all property types, with condominium sales jumping by 47%, single-family homes by 44%, and plexes by 34%, bringing transaction levels back to pre-pandemic highs. The backdrop to this surge is the favorable financing conditions that have ignited renewed interest from buyers. Lower interest rates have expanded the pool of potential buyers who can now qualify for a mortgage, fueling demand. Charles Brandt, Market Analysis Director at QPREB, notes that the return of more sustainable financing conditions is motivating both sellers and buyers to engage actively in the market. This environment has increased the number of households that can qualify for home loans. Brandt also highlighted a critical factor driving this momentum: the anticipation that the decline in fixed mortgage rates is coming to an end. This has prompted many buyers to act swiftly to secure their homes before competition intensifies and prices climb further. Notably, the latest reduction of 0.5 percentage point in the key interest rate has enabled approximately 12.5% of buyers who were previously unable to qualify at the start of the year to now enter the market, providing a particular boost to first-time homebuyers. In tandem with the surge in sales, Montreal's property prices have also been on the rise. The average price of a single-family home in the Montreal CMA reached $589,000, reflecting an 8% increase from the previous year. Condominiums saw a 6% rise, with average prices hitting $414,850, while plexes experienced a 7% increase, reaching an average price of $789,500. These price increases highlight the heightened demand and the competitive nature of the current market. This surge in sales and prices in Montreal provides an insightful glimpse into the dynamics at play in the housing market. It's a testament to how interest rates and financing conditions can significantly influence buyer behavior and market trends. As we move forward, it'll be interesting to see how these factors continue to shape the landscape, especially as we approach the end of the year. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time, and stay informed with the latest industry insights.